Mr. Buffett started sharing a story like this. I used to have a friend that was a stock salesman many years ago. Then one time, we ate lunch together. It would just keep going like this, keep on knocking and knocking. Finally, it would get to me, and I would ask, "What's that?" Then he said, "That's an opportunity." The interviewer asked these questions about intrinsic value to Mr. Buffett. Can you expand on the intrinsic value and what you believe to be the important tools in determining intrinsic value? Also, what rules, principles, or standards do you use in applying those tools? Lastly, how are that processes, the use of the tools, and the application of the standards relate to what you have previously described as the filters you use in determining your valuation of a company? Mr. Buffett started answering by saying, if we could see in it, looking at any business, what its future cash flows or outflows from the company to the owners or from the owners would be over the next 100 years or until the business is extinct, then could discount that back at the appropriate interest rate. That would give us a number of intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick a fair risk trade in. You can also reach one government bond with 5% coupons to another government bond with 7% coupons. Each of those bonds has a different value because they have other coupons printed. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument. It is up to the investor to try to estimate what those coupons are going to be over time. In high-tech businesses, they are still determining what the coupons will be. When they get into businesses where they think they can understand them reasonably well, they are trying to print the coupons out, and they are trying to figure out what businesses are going to be worth it in 10 or 20 years. When they bought See's Candy in 1972, they had to come to a judgment as to whether they could figure out the competitive forces that would operate the strengths and weaknesses of the company, as well as how that would look over a 10, 20, or 30-year period. If you attempt to assess the intrinsic value, it all relates to cash flow. The only reason for putting cash into any kind of investment now is because you expect to take some money out of it, not by selling it to somebody, but in a sense, by what the asset itself produces. It is even true when you buy a farm, a rental house, or a business. Several filters they describe that appeal to them that they don't know what that business will be worth in 10 or 20 years, and they can't even make an educated guess. Obviously, they don't think they know the 3 decimal places or 2 decimal places that precisely what's going to be produced. They have a high degree of confidence that they are in the ballpark with certain kinds of businesses. The fillers were designed to make sure they were in those kinds of businesses. They use long-term risk-free, that's government bond time interest rates, to think back in terms of what they should discount at. That's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by the asset itself will produce. If you're an investor, you're looking at what the asset is going to do. If you're a speculator, you're primarily focusing on what the price of the object is going to do, independent of the business. So they figure out, if they're right about the business, they're going to make a lot of money. And if they were wrong about the business, they don't have any hopes. In looking at Berkshire, what they put in their report are the things that they look at themselves. Companies like Coca-Cola or Gillette or Disney, those kind of businesses, you will see the information and the reports. You have to have some understanding of what they're doing. But if you have that in your everyday activities, you will get the knowledge. You won't get it in terms of some high-tech company, but you'll get it with those kind of companies. And then you sit down, you try to print out the future. Charlie, his excellent friend, shares something vital about it also. He said that one useful filter in investing is the simple idea of opportunity cost. Suppose you have an opportunity that you already have in large quantity, and you like it better than 98% of the other things. In that case, you can just screen out the other 98% because you already know something better. So, people who have a lot of opportunities tend to make better investments than people that don't have a lot of possibilities. People who have excellent prospects and use the concept of opportunity cost can make better decisions about what to buy. With this attitude, you can get a concentrated portfolio, which they don't mind. Their practice of that, which is so simple, is not widely copied. Mr. Buffett continues by saying that the attitude, though that is if somebody shows us a business, the first thing that goes through our heads is, would we rather own this business and more Coca-Cola? Or would we rather own it more than Gillette? There are very few businesses they have to find that they are confident of the future as companies like that. Therefore, we want companies where the certainty gets closer to that. And then we'll figure that we're better to buy more of those. If every management before they purchased a business in some unrelated field that they might not have even heard of, more than a short time before, that being promoted to him but they said is, this better than buying in our stock? Is this better than even buying Coca-Cola stock? They try to measure against what they regard as close to perfection as they can get. Charlie added the concept of intrinsic value used to be a lot easier because there were all kinds of stocks that they were willing to sell for 50% or less of the amount at which you could have easily liquidated the whole corporation. That is if you owned the entire corporation. Indeed, in Berkshire Hathaway's history, they bought things at 20% of their liquidating value. In the old days, the Ben Graham followers could run their Geiger counters over corporate America, and they could spill out a few things. They could easily see if they were familiar with the market prices of whole corporations that you were buying at a considerable discount. No matter how bad the management, if you're buying it at 50% of asset value or 30% down, you have a lot of going for you. And as the world is wised up and as stocks have behaved so well for people, stocks generally have gone to higher and higher prices. Now to find something at a discount from intrinsic value, those simple systems ordinarily don't work. You've got to get into Warren's kind of thinking, and that is a lot harder. He thinks you can predict the future in a few places if you understand basic ideas from a good general education. In other words, Coca-Cola is a simple company. You don't have the ability quantum mechanics requires. You just have to know a simple few things and deeply know them. Charlie talks about liquidation, not about closing up the enterprise, but about what somebody else would pay for also the cash stream. Part of investing and calculating intrinsic values is if you get the wrong answer when you get through. In short, if it says don't buy, you can't buy just because somebody else thinks it's going to go up or because your friends have made a lot of easy money lately or something related. You just have to be able to walk away from anything that doesn't work. We all know that very few things work these days. You also have to work and walk away from anything that you don't understand. In his case, he is a big handicap. It's much harder now, but he would also agree that almost any time over the last 40 years that they've been up on a podium, they would have said that it was much harder in the past. They also agree that it is more challenging today. And part of it, being harder now, is the amount of capital they run. He means if they were running $100,000, for example, our prospects for returns would be considerably better than they are. Running Berkshire was very simple at that time. There were times in the past when they look at things that very few people are looking into. Knowing how to calculate intrinsic value is useful for investors trying to get an investment's true value. That's because the intrinsic value is based on future cash flows, not simply where an investment may be trading currently. Value investors in particular seek to know the intrinsic value because it helps them understand whether an investment is appropriately priced according to their investing approach. Since knowing intrinsic value is considered fundamental to analyzing securities, it is a good idea for investors to understand how to calculate it.